Bitcoin has crashed before, and it will crash again. The question isn't if, the question is, what do you do when it does crash again? You see, some people panic sell. I see this all the time. Some people leverage up recklessly, and some people quietly position capital, which is the smart way. So today I'm going to walk you through a purely hypothetical strategy using an infinite banking policy to deploy capital into Bitcoin during one of the down cycles. This is not what I'm personally doing. So this is not financial advice. I'm just using this as a hypothetical example. And the primary purpose of the infinite banking concept is not speculation, it's taking back the banking functions in your life. But this thought experiment might completely change how you think about volatility and how you think about crypto and Bitcoin. Because volatility isn't the enemy, it's the lack of liquidity that is. So here's the narrative most people buy into. They think Bitcoin is either going to zero or it's going to the moon. There's no middle ground. It's hysteria on both sides. It's crazy to actually watch. But let's slow this down. Historically, Bitcoin moves in violent boom and bust cycles. Let me show you this. So I thought I would just draw this out. So Bitcoin works in halving cycles, and it's about every 4 years. Give or take, there's people that are much smarter in Bitcoin than me. I'm just giving you a roundabout example. So if we go back to 2013, Bitcoin peaked at $1,100. And that was crazy at that time. And then it had about an 80% free fall. We call that a drawdown. The next 4 years would take us to 2017. Bitcoin rose to 19,700. I remember that. Then there was an 84% drop, pure hysteria. It fell to $3,200. Over the next 4 years, the halving cycle got us to 2021. It made its high at $69,000, give or take a buck or two. Then it had a 75% drop. So just real quick, think about this. 2013 seems like a long time ago, but it really wasn't that long ago. 1,100 bucks. But it fell 80%. How many of you think you would have thought the sky is falling? It's going to zero. This was all just a big scam. But then, over the next 4 years, in 2017, it makes it to 19,700. People are like, oh my God, this is amazing. But then it free falls another 84%. The sky is falling again. It's going to zero. This is what we were talking about. 2021, we had a little bit more relevance on this, but it still had a 75% drop, taking it back down to 16,000. But now I think a lot of people are thinking, okay, maybe it's not going to zero, but this is some crazy, crazy cyclical action here. This is wild. And we call that volatility. But let's keep going here, and I'm just going to kind of push this forward. We had another 4 years, which takes us to last year, 2025. It made a high of $73,000. I was like, that's insane. But those who are in Bitcoin were like, that's going much higher than that. But before it did, it took a drop of 25% down to 50,000 in 2025. Now remember, we can't go into the future because we haven't hit the next halving cycle. But here we are in 2026. And in 2026, if we look at Bitcoin, it made a high of right around $123,000. This is just recently. Right now, today is February of 2026. And we recently just had another one of those pullbacks, and it is sitting right now at 65,283 when I last checked it. Just let that sink in. That's a lot of volatility. Now, not all of what I just said is the halving cycle. There's a lot of other factors, and right now, those factors are a lot of geopolitical factors, tariff factors. I mean, there's a lot of things playing into this. But I just wanted you to see how this thing has been trending in those 4-year cycles. But let's dive a little bit deeper, because I'm not here to talk like an expert of Bitcoin. I'm definitely not that. But I am an expert of the infinite banking concepts. And at every single time that I just mentioned, retail investors, they piled in near euphoric highs. Media amplified this whole mania. We've seen this over and over. And when fear dominates at the bottom, well, everybody freezes. People get scared. They sell it. They start saying, oh, it's not real. It's just a story. But the real story isn't price. The real story is liquidity. just like I mentioned. So what's actually happening here? Well, Bitcoin doesn't move randomly. It moves in cycles like I just showed you, and there's other cycles as well. Historically, it has followed this, the 4-year halving cycle. Every halving reduces new supply issue, and at the same time, liquidity cycle matters. When the Federal Reserve tightens, risk assets, like Bitcoin, they struggle. When liquidity expands, risk assets surge. Bitcoin is not isolated from this macro liquidity. Now think about this. Michael Saylor, you probably have heard of him, Microsystems. Whether you agree with him or not, he has accumulated billions of dollars in Bitcoin across these different cycles. Not because he guesses tops perfectly, he's never got it right, but because he believes in a long-term structural scarcity, which is Bitcoin. Okay? Again, this is an opinion, not a prediction. But here's what the important question is. If these cycles are predictable, and if this structure is real, and it's not price, what matters more? Guessing the exact bottom, or having capital when fear is at the highest at points like this? So most people don't miss Bitcoin because they don't believe in it. I think at this point, most people have some belief that Bitcoin's around for the long haul. They miss it because they don't have the liquidity. They don't have the liquidity because their capital is trapped in something else. Retirement accounts, for example, their money's locked up till 59.5. Equity's tied up in housing or real estate. Cash is sitting in untouched emergency funds. Or worse, you're just maxed out. So when Bitcoin drops 70%, they don't buy because they can't, but they freeze. Even if they have liquidity, they freeze. They're like, oh my God, where's the bottom? Don't chase the bottom. Chase controlling capital. You see, the control is everything, and that's how Michael Saylor has done it. He has been in control. He has not gotten emotional. He has not chased the bottoms. But most people say, buy the dip. Okay, with what? You're going to buy it with margin? You're going to buy this dip with margin? Well, that increases risk dramatically because now you're paying interest on the margin. Oh, I'm going to buy with my HELOC. Now your house is tied up to a volatile asset? Oh, I'm going to liquidate my retirement assets. That's going to trigger taxes and penalties. Oh, you got high yield savings? Great for safety, terrible for opportunity. Cash under the mattress? Well, inflation is slowly eating that alive. So if leverage is dangerous and speculation is purely emotional, but what if the move isn't about leverage? What if it's about liquidity control? That is what we're going to talk about. Because what if you had capital? What if you had capital you could deploy without selling assets? What if you could continue to earn on those assets but still invest? Well, that's where the infinite banking concept becomes very interesting. See, a properly structured whole life insurance policy builds cash value, and that cash value grows on a guaranteed basis, and then you get dividends every year in participating company. And that liquidity, called cash value, you can access that through policy loans. You don't have to liquidate your policy, you don't have to liquidate your money, you're going to borrow against it. Kind of like a HELOC, but you're not tying up a house. Your capital will continue to compound, and you gain the liquidity. Let me show you this in a simple way. Let's just say you had $200,000 in your policy in cash value. Now maybe you built it up and capitalized it to get there, or maybe you just had 200 grand in a bank account or a high yield savings and you just transferred it and dumped it into the policy. We can design them any which way you want. But let's just assume that Bitcoin has one of its notorious 70% halving crashes, okay? Let's say it goes from 70,000 down to 21,000, purely hypothetical. Now, you got that 200K here, but Bitcoin crashes 70%. Let's just say it goes from $70,000 down to $21,000. Now this is purely hypothetical. I'm just making this up. You started with $200,000. You took a $100,000 loan from the insurance company. So are you thinking you have $100,000 left? No. You still have your full $200,000 earning uninterrupted compounding interest, while you got to use the $100,000 to invest in this Bitcoin event where it fell significantly. So you take the 100 grand, you position it in Bitcoin, and you buy it at 21,000 because it just was 70, but it free fell down to 21,000. And let's just say Bitcoin over the period of the next cycle doubles. So your 100,000 becomes $200,000. You sell it. You repay the policy loan of 100,000. So now your policy's made whole. The remaining gain is yours. You just made $100,000. And throughout this entire process, you never exposed your home. You never triggered any retirement penalties or taxes. You never used margin. And your capital base, the full $200,000, continued to compound. So let me be crystal clear. This is purely hypothetical. We're just making numbers up here. But in theory, this is something that I'm looking at saying this could happen. But it's not financial advice. The primary purpose of the infinite banking concept is to recapture and recycle debt, or recapture and recycle money that you're giving away. It is not normally used for speculative, volatile assets like this, but I'm just saying, if someone really knew, liked, and understood Bitcoin, maybe this could be an option. And if this is how it worked, well, wouldn't you be better off buying it with your policy, using the infinite banking concept than you would from a bank account? Yeah. But let's not just guess, let's talk about it. So let's just compare. Let's say you did it from a home equity line of credit. Well, you would have had a variable interest rate, your house would have been at risk, and the bank and the Fed control your outcome. How about a 401k? Well, you could have penalties, you could have fees, you lost compounding on it. Even if you took a loan, you could only get 50 grand. And there's other dynamics, like if you lost your job or you left the employer, you'd have to repay the loan if you took a loan. So again, 401k might not be the best. But high yield savings, well, that might be one that would work here, but you're making minimal growth. You have no leverage, okay? And you're losing opportunity costs, because when you take the money from a high yield savings and you buy Bitcoin, you're not earning on that high yield savings anymore because you depleted it. But the high yield savings is the only one that makes any sense. But let's talk about what we just did, the policy loan. It's a contractual guarantee. There's no credit check. There's flexibility on your repayments. You don't have to pay the $100,000 back anytime soon. It's your system. It's your money. Therefore, it's your rules. You see, the wealthy don't chase returns. They chase control of their capital. That's the difference. And that's what I was trying to show you. Now, I understand this is sort of sophisticated thinking. This is not something that I'm doing, but it's definitely worth talking about. It isn't gambling on Bitcoin. It's about positioning capital for asymmetric opportunity, which is exactly what we just showed. Historically, major wealth has been built during these fear cycles. Buy low, sell high, and don't lose money. And many wealthy families, including historically the Rockefellers, they've used life insurance structures just like this for liquidity, estate planning, and private banking control. Again, this isn't about Bitcoin. Bitcoin's just the example because it's a hot topic right now. This is a lesson of how you can control your liquidity, how you can control opportunities, and how you don't have to give up opportunity cost to do this. Now, if you're serious about financial control, if you want to understand how money actually moves, like we kind of talked about, help us get to 200,000 subscribers by clicking the subscribe button right there. There's a little bell up top. Now, I've been studying under the one and only Bruce Lee, and I want to just show you a new trick. It involves a backflip. Can I show you this? So what I'm going to do is I'm going to do a backflip, and I'm going to kick and smash the bell at the same time. This is pretty cool. Now, hang on. Let me get limbered up here. All right. Ready? All right, you're going to smash the bell at the count of 3. Give me a countdown. 1, 2. Ah! Oh, whew, that was a good kick, right? God, I'm getting old for those. Back. Anyway, if you're watching this and you're thinking, man, this sounds awesome, but I want to model this scenario first. I want to look at the mathematics. You're just like us. That's exactly why we built the Vault software. You see, inside the Vault, you can run exact policy modeling. You can see the exact mathematics, you can see cash value projections, you can test loan scenarios, you can analyze the repayment timelines and see what it does because of the compounding interest and the simple interest. You can study real case structures. We don't tell you what to buy, we don't give you stock tips, but what we do is help you understand how to deploy your capital strategically, and the Vault software just makes it so much easier. It's like your operating system or your GPS. That's it. So if you want to check that out, right in the description, BYOBvault.com. Listen, if you're building your own private banking system or you think it sounds interesting, then scan that QR code you see, or right up in the description, click the link to book a strategy call with one of our mentors to show you how to do this. And they can run some scenarios as well. But if you haven't seen it yet, I want you to check this video out right here. Watch The Secrets of the Rich. It will absolutely change how you think about capital and how you think about your money. See you next time. Thanks for joining.